Hi, I'm Amelia Bordeaux. I'm the founder and CEO of Market Compass, and I'm here today with my friend Paul Craig. He is the founder of View from the Peak and the U.S.-China series, and I'm so happy to be speaking with you today. And you're coming to us from London, is that correct?
Amelia, yes. Everyone, thank you very much for having us. Amelia and I haven't done this for a very, very long time, and there'll be some of you who may know this, most of you won't. But Amelia and I worked at a hedge fund together back in the mid 2000s. I've known this woman for a very, very long time, and I'm really glad to be doing this.
Yeah, me too. It's great to catch up.
So you mentioned, like, there was, before we started press record, that there was lots going on today, and a lot of it revolves around the Fed. A lot of it revolves around sort of maybe we've gone too far for too long and getting scared about COVID 2.0. You were my Fed guy for many, many years. I'm going to re-up that. Tell me about what happened yesterday.
Well, thanks. It's a lot of pressure to be the Fed person, but in any event, yeah, I did work at the Federal Reserve Board. That's where I started my career, back in Washington, D.C. So I did watch the whole Powell, announcement and press conference yesterday. I actually like how he's been communicating with the market. I think it's been very straightforward and clear, and I do think he's trying to appeal to a larger audience. I think he knows that more Americans are invested in Fed policy now, just from watching him on television. And so I actually liked his presentation yesterday, but he said two things, and it was very interesting how the equity market is reacting. This morning, the Dow was down 900 points on the open, so it's kind of like a turning tide today. But the first thing he said in the Q&A was that the Fed is not even thinking about raising rates. And so normally when you hear that from a Federal Reserve chairman, I mean, would support equities. I think what's impacting equities maybe today is with the jobs number, and that's debatable, the quality of that data that we saw in May, that 2.5 million rise. It was kind of like off to the races. Like, wow, everything's open, people are getting their jobs back, equities were up, and he put a damper on that yesterday. He forecast a 6.5% contraction, or the Fed does, in U.S. GDP, which they estimate about a 2-year time period to dig out of that. So, that doesn't signal a V-shaped recovery at all. And so that threw cold water on kind of this notion of a V-shaped recovery. And so the equity markets, as you know, they're so fickle, right? Like, there was such euphoria when everything in the U.S. at least started to open, and now that it's open, they're very fickle, and they've turned their attention to, well, everything's open, so there's going to be more cases of coronavirus, and is there a second wave and another shutdown coming? And it turns so quickly.
It turns so quickly. I mean, it's funny, like, through all of 2019 primarily, I thought Powell did an awful job at communication.
Yeah, I agree, yeah.
So if you go back and look at sort of market performance, both across all asset classes, the times where you had major risk corrections in 2019 really weren't related to things like US-China trade tensions and the like. They all revolved around Powell sort of stepping over his skis a little bit and getting too hawkish.
Right.
He did an awful job for most of last year. But frankly, if you look at global policy efforts around COVID, both monetary, fiscal, health, the whole shebang, Powell's up there with one of the best performers globally in terms of what he had to do, right?
Yeah.
Now, as we know, the Fed big picture couldn't do a lot without government support, right? Because as you know, Fed cannot take a loss on an investment. Therefore, they can buy mortgage-backed securities, they can buy government securities, but they can't take a loss. So the only thing they can do is leverage the first loss capital that Treasury was able to give them. So they did that successfully, but frankly, that's not the hard bit. The hard bit was back in March when you had dollar funding squeezes, you had dislocations in treasuries and the like, that they did what they needed to do, i.e. get markets functioning again.
Right.
And I think that they did a wonderful job. That was first reflected in the treasury market when things started to calm down a bit, but certainly the amount of investment grade issuance that happened from April onwards was really in no small part to the Federal Reserve calming things down.
And I think they did it quicker than 2008 too. I think it was faster Seemed faster
It
than
was
that.
much faster. It was much bigger and much faster. Now, certainly they had a quicker They had a quicker response from Treasury, right? So if you remember back to '08, it took until till October 3rd for the package from Hank Paulson to actually get passed. So TARP and TALP were passed on October 3rd of '08, or it was agreed upon on October 3rd of '08. And if you remember, there was a period late, I think it was either 25th, 26th, 27th, something like that, where the bill went up and it failed.
Yeah, right. Yeah.
And, and all hell broke loose. But this time around, you didn't have that. And again, I think in no small part to Powell, he and Mnuchin clearly have worked well together through this process. And look, we're back to a world where, despite the fact that Powell didn't give us this constant, ever increasing stimulus that equity markets want, it sort of happened at a very inopportune time for markets, because from an equity market standpoint, you had an incredible amount of alpha that was generated in May. So what you had was, high quality companies did great, poor quality companies didn't do it as well.
Yeah.
And there was a hell of a lot of alpha that was generated. Then June 1 came, right? And Macy's is up 50% in a week.
Yeah.
And call it a value over growth, call it quality versus vulnerable. Well, that'll reverse. Now, are we really surprised that we had as we came out of COVID, or as the first wave, we're not going to get into the arguments about second waves yet, but as we came out of that, well, there was always going to be a sell the winners, buy the losers trade.
Yeah.
Right? And that's why American Airlines tripled and Macy's tripled and all this sort of stuff. But
kind of like those are the reopening stocks, right? The retail, the travel.
Yeah, but at the end of the day, all that alpha that was generated in March, well, that all blew up, right? Because people were still, if you're a high quality long short equity firm with a reasonably long investment time frame, you're not going out and you're not going to buy Macy's and sell Facebook for anything but a trade,
right?
Right. So you had, by last week or by the start of this week, particularly Friday, I mean, it was just all hell was breaking loose. It seemed like Carnival Cruise Lines was going up 20% every day.
I had seen that, yeah.
So I think that, and look, I mean, you're very, very dollar focused.
Yeah.
And we'll talk about sort of the arguments for and against a sustained dollar sell-off in a second. But if you look at a chart of the OIH, if you look at a chart of the Brazilian real, if you look at a chart of Freeport, if you look at a chart of Macy's or any of these, anything that was vulnerable during COVID, it's all the same chart.
It's the same, yeah.
And the dollar currently is the same as all of those.
Yeah, you can just chart the DXY index, the dollar index developed, and then, U.S. equities and how they just, especially since mid-May, they just, equities rose and the U.S. dollar was just sliding and sliding away. And when it hit 98, which was a big support level, it slid really quickly, even lower. And, I just didn't think it warranted it. VIX remained above 20, which is what traders normally thought of as you're getting into a riskier area. Then it had been mid-20s, sub 30, but now, of course, well above 30 today. And to me, a VIX above 20 and the dollar index sliding so quickly didn't really make a lot of sense to me. We were talking before how, the dollar is a high quality asset. It's certainly the safe haven, one of the safe havens of last resort. I don't say the safest safe haven, but it's when everything really is globally wrong as opposed to wrong in one region. The flight to quality is always to the dollar, sometimes to gold. But that's what's been happening. And I just thought, everything can just turn on a dime. You just need one headline or one fickle refocus of the market, like today with it seems to be the driving the headlines are second wave is restarting, or and that's driving this move. But really everything was just overdone. It was just overdone. It was like, how can we sustain this move. I understand the Fed, is backing it with all the liquidity and global central banks. And then the other thing that was contributing specifically to the dollar index is the euro, because it's 57% of the dollar index, and the fiscal packages that have come out of Germany, and the big PEP program from Europe, and the possibility of kind of a joint issuance Corona bond that Merkel and Macron are talking about. Those things are really euro supportive. And so euro really had that leg up, which pushed the dollar, I think, a little further lower.
So think of it, Amelia. Think of it this way, right? So there's legit good news, and joint and several liabilities for European countries in terms of joint bond issuance. That's constructive, very, very constructive longer term, right? Undeniably so.
Yeah.
But we've talked about this a lot in the past, but the world is about creating narratives around price action, right? So when you have a squeeze in Brazil, when you have a squeeze in Macy's, when you have a squeeze in oil stocks, people are trying to find the positive narrative around that, right?
Yeah.
Now, I can give you a really constructive, positive, long-term, sustainable positive narrative on mega cap technology. If we had an hour, I can give you the narrative in an hour, but let me give it to you in 30 seconds, right? Forget the fact that, if you're going to have interest rates at historically low levels, I would argue for, at a minimum, the next 3 years, right? I think it's considerably longer than that. But if you have that scenario, then the price that investors should be prepared to pay for very reliable cash flows for a Microsoft, for an Apple, for an Amazon should go up precipitously, right? So that's number one. Number two is, in the post-COVID world, these are the companies that will dominate the way we work, the way we spend, the way we shop, the way we entertain ourselves. And that's going to be, it's going to be Amazon, Apple, Microsoft, Facebook, etc. They will dominate. So if you look out over an economic chasm that we have in front of us, which could be, if it's V-shaped, it's 2 quarters. If it's U-shaped, it's 4. If it's L-shaped, how long, we don't know. At some stage in the next 12 to 24 months, we're going to get past this, and we're going to be left with these half a dozen companies. And if you want to throw in things like Tencent, Baidu, and Alibaba, you've got, let's say, a dozen or so companies around the world that are going to dominate every facet of our lives. That's Microsoft, under that world, trades at 50 times forward. Apple should trade at 50 times forward. What I don't get is American Airlines tripling in value when, if you and I were having a discussion 3 months ago and I said to you, Amelia, I think American Airlines is going to operate at 70% capacity by the end of the year.
Yeah.
What would you say?
Right?
You'd say it's probably a bankruptcy candidate.
Yeah.
Right? And that's where we are. So there's things I can justify and there's things that I can't.
Yeah.
The dollar is, for me, as you alluded to, the ultimate quality asset, right? Now, if you look at traditional metrics for why people invest in particular currencies, particularly emerging market currencies, volatility to carry ratios are one of those things. So if you've got low vol and high carry, own it all day long. If you've got low yield and high volatility, really bad investment. So the dollar, which was the high-yielding G10 currency for years, in a low-vol world, that's a bid for the dollar.
Yeah.
But today, as yields around the developed world have gone to zero, and volatility's gone up considerably over the course of the last 3 months, and one should expect that we're going to have a lingering that volatility across every asset class should certainly be elevated versus where it was over the last couple of years to the quarters ahead. So the dollar's less attractive in that world.
Yeah.
Right? But, if we're going to have credit issues, we're not getting out of this unscathed from a credit perspective.
No, right?
So if you look at what are we likely to see in July and August? So, July and August is when credit comes home to roost, because July 1, there's a bunch of high-yield bonds that need to pay their coupons.
Okay.
Right? Semi-annual coupons on July 1st.
Oh, on July 1st.
There's a bunch that are going to miss those.
Okay.
Miss those payments. So I think we go from a world where we had a bankruptcy every week, right? Because you can't shut down the global economy, take $10 trillion out of the global economy and not expect bankruptcies.
Yeah,
you can't have a world.
You're absolutely right. And I just don't know why that hasn't been the focus. There's been a lot of sentiment of everything's going to come back, and of course, not everything is going to come back. Yeah.
No, you can't live in a world where you don't pay your bills,
Right,
and expect someone not to default. So, so you think about it this way: that come July 1, right? We're reopening the economy. Do people start paying do small retailers pay their rent in July?
No, I mean the same thing in the U.S.
Right?
The furlough of the mortgages, right? That was only 3 months. So, people have been pointing the same thing, like how stable the housing market is. Well, we need to wait another 2 months to see once those furloughs roll off, from Wells Fargo.
Right. So Q3, you've got some problems, right? So you have one of the big stress points for me is private equity sponsored mid and small cap companies, because they can't access the Fed window. There's no money for them.
Okay.
Right. And PPP loans were great. PPP loans were a vital part of stabilizing a bad situation. But that's passed. So PPP loans were 8 weeks worth of expenses, two and a half months worth of salary.
Okay.
Right? It was what a PPP loan covered.
Yeah.
Well, that goes back mid-March to the start of June.
Right.
So that stuff's done. If you've kept your staff on, right? And one can make an argument that the payroll number on Friday reflected rehiring to make sure people
PPP loan,
were on the books to make these loans grants versus having to pay back the government, right? So there's an element to that.
Yeah, that's interesting.
But what do we do? Where's liquidity come from going forward? And look, you and I talked about this last week. In Jacksonville, if you go out to restaurants and the like, they're jam packed at 50% occupancy.
Yeah.
Do you know many restaurants that can make a profit on 50% occupancy?
No, yeah, it's tough. And when they first opened, 2 weeks ago, and they opened a 25% capacity, and some did not open. And I talked to them. I went in and I talked to them. They were cleaning up and stuff, but they weren't open. And I said, "Are you opening?" And they said, "No, we need to wait to 50." And some were waiting to 100% capacity because they didn't want to operate, at 25%. And it's 100% overhead for 25% capacity, pretty much is what they all told me. And they're like, "We just can't do it." And the other thing that's happening here in Florida, which is really interesting because Florida has, I think overall, different counties are differing, especially Miami-Dade, but Florida was one in the United States where they were very worried that Florida would be Italy, with the death rates and the older population here. And so that was not the case. And at least here where I am, the positive case rate and the hospitalization rates were very low. And I think Florida overall surprised kind of to the upside relative to what they were expecting, which was a total disaster. And so we've been quick to open, quicker than other states. And people have been very excited and I think rather bold about it. And it's been going well here in this area. But there's a little bit of like consumer sentiment, I think, retrenchment starting, and that there's been talk, though it's not 100% confirmed, that Florida will get the Republican National Convention here in Jacksonville in August.
From North Carolina.
Yes, and there's been a little bit hesitancy, like, oh, well, we want to open up and have tourists for the summer season, but we don't really want to have 200 or 300,000 people come for this one weekend, So there's been a little bit. That's the first time I saw this area a little bit hesitant or scared, just the average person of, in terms of a second wave. And I hope that doesn't negatively impact consumer sentiment here. And the other strange thing about Florida, because it's a state that's being very watched, as is Texas, as is Arizona, in terms of the cases for the second wave, is, we had the Super Bowl in February 2020. Possibly the RNC in August, and then the Super Bowl again in Tampa in 2021 of February. So, just hosting these major events is going to be interesting to see how it all pans out.
Yeah, and again, we don't have an edge in any of this, right? No. So for those who don't know, I'm Australian. If you haven't already worked that one out, but I look at my family in Australia. Australia got away unscathed. Now, was that really good policy? Or was it the fact that it wasn't flu season? So we just don't know about this sort of stuff. But and the trouble, Amelia, when you're looking at assets in general and trying to work out how to value assets. Being confident about owning equities at this time is really, really difficult, because if company after company is pulling forward guidance, right? So if companies are telling you they have no idea how much money they're going to make on a 12-month basis, then how can investors be confident buying companies based on profit forecasts that companies won't confirm or deny? Right. So, I think that the way we have to look at this is more across all asset classes. This includes, particularly in the currency world as well, you're looking more at balance sheet and more at business models. And you can take emerging market currencies and look at them through a similar lens, where you can look at the balance sheet of Brazil, for all intended purposes, and look at the fundamental drivers of the Brazilian economy. And then you can also look at things like issues of carry and the like. And look, EM struggles. EM's got some real issues going forward.
And it takes them longer sometimes to emerge. I think they're behind in terms of the peak infection rates. They were behind, I think, some of those countries, and so.
And they don't.
They're lagging a bit. I think they're lagging the peak infection, and they're lagging the recession, and they're lagging. That's my impression.
Yeah, and Brazil's a bad example. Well, sorry, Brazil's a good example, because you've got a guy in Bolsonaro who just who's been clueless through this entire process. But Brazil also, but I don't care if it's Brazil or India, South Africa, you name it, they don't have the fiscal ability to do what the developed world has done, right? So you're not getting the equivalent of a $750 billion joint package across parts of Africa or parts of Asia, for example. And if it gets bad, then that becomes a problem. They don't have that firepower. But look, at the end of the day, they still live in a world where the Fed dominates everything. Going back to our point before, Powell's done a fabulous job at his communication has improved out of sight. He did everything he needed to do in regards to creating sort of a safe work environment for markets to go back in a safe and stable environment. And he and Mnuchin have worked remarkably well. The question is now, this is not about liquidity per se now. This is about how quickly we get to what I call terminal velocity, right? And terminal velocity is where companies big and small can get back and stand on their own 2 feet and go back to profitability without government assistance. And I have no problem with investment grade companies.
How do you start to measure that, or what are the first signs you can tell that that's happening?
It's difficult. High yield's the easy one, right? So high yield's the easy one, because if you'll see defaults and you won't see defaults and the like. You're starting to see and the announcements effectively of forward-looking redundancy. So BP announced it will eventually hire 10,000 people.
Like
American Airlines.
Staff,
American Airlines, which is just completely disingenuous, takes government funding, doesn't fire people, not allowed to fire people for 6 months, but they're basically announced on that date when the 6 month time frame kicks over, we're going to fire 30% of our white collar workers. I mean, it's so how do you look at this? I mean, the key question for me is small business is going to be decimated. And that's a tragedy. That's more than an economic tragedy. That's a social tragedy for small companies disappearing. But the couple of questions. One, does that affect the broader market? Right. So I use this example.
Do you think so?
I don't. Well, okay. So think of it this way. My local pizza place in Chicago.
Or sentiment or some, secondary impact as opposed to.
100%, right? So if you have 1,000 pizza restaurants that close, right? That's a tragedy for the families that own those pizza restaurants. It's also a direct economic impact as well, because there's less spending in those areas, and there's no rent on those buildings, and there's a flow-on effect. But is that a good thing for Domino's Pizza?
I don't know.
Right. So if Macy's goes bankrupt, is that bad for the economy or good for Amazon? And these are the questions I think we need to be asking ourselves, because as we stand today, the economic beta, we'll call it, of 15 to 20% unemployment wherever it is, right? Well, it hasn't affected Amazon, even though I know myself as a big user of Amazon, my discretionary spending has gone way down in the last 3 months.
Right.
But but I'm buying a shit ton of hand sanitizer and books.
But where are you buying your discretionary spending that you're spending? You're buying it off Amazon.
Yeah, so instead of me going and shopping at Whole Foods and the like to get my groceries, I get that stuff delivered via Amazon. Obviously, Whole Foods is Amazon, but instead of going to the store, I get it delivered. Right? Is that habit going to change? Maybe, maybe not. You know, I still don't mind going to the grocery store, but so the habits will change.
It might change for a certain segment of the population, though. I mean, people who are immune compromised may feel uncomfortable for a very long time returning to, grocery stores are packed. They were one of the most crowded places to be, actually, during the shutdown. So yeah, for a certain segment, it could definitely shift permanently.
Yeah. So and again, my disgust of cruise ships has no boundaries. I will never go on a cruise.
I will never go on a cruise either. I'm so scared of them. I was scared of them before this whole thing even happened.
And there's going to be an element of people, right? Who my mum likes cruises. Right.
There's like a ton of,
never going with you.
They have a big cruises, like people love them. I never understood them, but yeah.
Now, my mum's 78, and is she going to go on a cruise again? Probably not, right? She probably won't. But there are going to be plenty of people who will. And that's the part of the life getting back to normal. And The Economist did a great piece about 2 or 3 weeks ago called The 90% Economy.
Oh, okay.
It talked about if we're going to go back to a world where we run at 90% capacity, because you know what? Vegas is never going to be Vegas again. It might get to 90%, but there's going to be an element of people who just won't go again.
Return, yeah.
And who won't fly again. And it's the marginal people. And I think the bigger issue for flights is Zoom is going to kill business travel. Right?
Yeah.
Because
plus, there's a risk to business travel now. I don't know, legally, for a giant bank to be sending their employees around the world, I mean, they're going to have to block lawsuits or something if somebody contracts COVID on a
absolutely
business trip. They didn't want to go on and they were forced to go on, But...
Yeah, so there's going to be less of all of that. So the 90% economy is getting us back to almost where we were, right? So if I go out to dinner 10 times, I may go out 9.
Right.
And it's less than what it was. But we lived in a world where, particularly in the US, that we optimized everything in terms of supply chain optimization, cash optimization. I mean, every spare dollar of cash from a corporate seemed to outside of a slight cushion, went into share buybacks, and we borrowed money to buy back shares, and we optimized everything. Mm-hmm. So what do our business models look like in a world that's less optimized, where Apple, instead of carrying 10 days worth of inventory, carries 20?
Yeah.
And 3M, that did all its medical supply chain in China, suddenly has medical supply chain in Vietnam, Estonia, or wherever. Right?
Major companies are definitely going to shift their supply chains away from China. I don't know if you have a view on, does that impact China at all? But they're going to shift.
Well, it will impact China, but the point is immediately that if you've got 3 hubs of supply chain for whatever product it is, that's just more expensive.
It is. That's true. Yeah.
It cuts margins.
But they're going to have to diversify the risk, I'm assuming. Yeah.
100%.
Yeah.
And eventually that's a drag for China. I mean, I think it's less of a drag than what people think, because I think there is a large domestic consumption revolution that's going on within China that's been brewing for a while. Okay. But look, it'll hurt. It'll hurt because, at the end of the day, what COVID did was it just was an accelerant on the fast tracking of change everywhere, right? So I don't care if it was the demise of movie theaters, the breakdown in globalization, the unwind, the death of the WTO or the World Health Organization, be it Black Lives Matter. I don't think there's any
social disparity, between people in the economy, the winners. I hate to say it, but the winners and the losers, like, can you imagine if your business was deemed essential as opposed to not essential, how you're going to emerge from this versus if you were non-essential? I mean, even the restaurants here, this is happening everywhere, but that were now selling groceries just so they could remain open to be a grocery store because they couldn't serve, just how it's like the construction industry here never stopped working. They were deemed essential, but in Manhattan, I know they were non-essential. So
It's look. I mean, at the end of the day, it's very the people who push back against the Fed as a vehicle of creating income inequality, their arguments are really darn strong now. Right, because if you've got an environment where we're going to keep, where let's face it, you're more likely for your kids to die of a lightning strike than to catch COVID, than die of COVID. Right, yet we've got school shut, which is incredibly discriminatory against single mothers who can't work, against low income families who have two workers who one of them cannot work, and you've got zero rates everywhere, and the Nasdaq at an all-time high.
Yeah.
So it's really, put it this way, at a minimum, the income inequality arguments that have been driven by preventing people from working and the Fed doing what it's doing, they're hard to argue against right now.
I think, Powell reiterated it again yesterday. I think the Fed is getting increasingly, I want to say, nervous about this. He really looked into the camera yesterday. I watched the whole thing and said, we have lending powers, not spending powers. And he urged once again the government to step in with fiscal programs and he, in response to a question, I believe, about income inequality, and the wage gap. So, yeah, I mean, social unrest and income, widening it, that's not good for any economy, So,
no, and as this fast tracking of change occurs, one of the big areas which is flying under the radar right now is just U.S.-China relations are just capitulating right now.
Yeah, absolutely. I wanted to ask, it's so fascinating to talk to you. I always learn so much, but U.S.-China relations, we had the whole trade war in 2019. That was all, it moved the equity markets. I know you were saying that it was actually Fed, but I think it was a little bit of the trade war. But anyway, it moved. It was the main focus of the markets throughout all of 2019, and I wonder why it's dying down now. Behind the scenes,
it's not dying down. That's the thing.
Here's what I headlines every day. We're consumed with coronavirus and social unrest.
It's flying on the radar. So here's a great stat for you, right? So currently in this current Congress, there are 330 anti-China bills in front of Congress. And they range from Marco Rubio's Equitable Act that is part of the delisting of Chinese companies from U.S. exchanges. There's a bill about reparations for the quote-unquote Wuhan virus.
Right.
There's issues on cybersecurity. There's issues on CFIUS and bilateral investment. There's a slew against Huawei and the like. So 330 currently. After 9/11, there were 113 counter-terrorism bills.
Oh, interesting, yeah.
Right. So what do we know? We know that anti-China rhetoric in the United States is as high as it was, is higher now than it was after Tiananmen Square. Right. So anti-China polls well. Right. We also know that this next election is going to be fought between two candidates who are basically going to say that they're tougher on China. So. There are a lot of Republican hawks against China. There are an equal amount of Democrat hawks. And they are the issues may be different. The Democrats may be more focused on things like Xinjiang and human rights and democracy movement in Hong Kong and the like. But at the end of the day, it's an anti-China rhetoric which is in overdrive. Now, I personally don't think the markets responded that much to US-China trade tensions last year. The S&P was up 30%, and you had some blips, but those blips happened to coincide often with like May and July with Powell making some hawkish statements, right? So at the end of the day, the shattering of globalization, which I firmly believe we're in the middle of that right now, if the S&P is up 30%, well, it doesn't really matter that much. And with COVID, what you're seeing now is, as you said, it's dominating the headlines, but every day you're getting more and more anti-China statements that are coming out. So there is a bill that Tom Cotton has put forward called the Campus Security Act, which basically would make a Chinese researcher at an American university have to register as a foreign agent. It would limit the number of Chinese students coming to universities. And one of the things we're going to be doing at US-China series in the next 3 months is doing a day-long symposium on scientific collaboration and education. And we've got this wonderful guy called Bill Simons, who's Dennis Simons, who's at the who runs Duke University in their Shanghai campus, Kunming campus, and he talks about the threats that are being made to sort of educational collaboration and the like. The entire relationship is breaking down, and
who will that impact more? Like, when do you think, in terms of the U.S., when do you think that will hit here in terms of the markets or in terms of a reckoning, or are we delaying everything until after the presidential election, you think?
No, we're delaying it until just before, right? Because again, Biden currently is running attack ads on Trump being weak on China or through every swing state, right? And Trump, what I think Trump does is the Chinese have missed every purchase target.
Yeah, the Peterson Institute tracks this really well. They have all the charts of the Phase 1 trade deal. Yeah, go there.
So for you guys out there, follow Chad Bown at the Peterson Institute. He knows this stuff cold. He's amazing. But they've missed all the targets pretty much because of COVID, right? So if the price of oil halves, from a volume perspective, China had to double the volume they were purchasing to do it, and they just couldn't do it, right? So what I think happens is Trump uses that as cover. He pulls out of the trade deal in October, right? Now, why October? It's October, so it's before the election, but the economic consequences of pulling out of the trade deal don't happen until after everybody votes.
Yeah.
So I think that is for me, that's a very likely scenario. But this election is going to be fought on China bashing because it polls well, it's bipartisan, and frankly, Trump's got to blame someone for what's gone on in the economy in the last 6 months, because
he always ran on the strength of the economy and the strength,
100%. So if Trump's Herbert Hoover, right, where Herbert Hoover oversaw the Depression, and employment went from 4% in 1928 to 18% in 1932, and Hoover was swept out of office. Or if he's FDR, and FDR had double-digit unemployment basically for his entire nearly four terms, and he was fine. He was re-elected on 3 occasions. So I personally don't think Trump's FDR, and he's got to do something to blame someone for the handling of the virus and the economic consequences, because the numbers don't lie.
Yeah.
If you go into an election with double-digit unemployment, you lose.
Just talking about all these issues, it's just unbelievable in terms of safe haven assets. The dollar, in terms of an equity, a possible extension of this equity rally. There's so much risk. There are so many risk events that can hit at any time. I mean, we still haven't solved the Brexit between the UK and the EU trade deal. That deadline's coming up at the end of June, and then there still could be a possible hard Brexit at the end of this year if they don't come to some sort of terms. I mean, we have the US presidential election, and we have China social unrest. I mean, Hong Kong, democratic protesting there. I mean, there's the social unrest here. There's so many variables.
But you think about safe haven assets, right? So is Fang, I saying this wrong, Fang's the new safe haven asset, right? And Fang's the new safe haven asset because Microsoft, for all its dominance, has 2% of its revenue in China. Right? So if Microsoft left China tomorrow, it'd make a really big headline, but would it matter to the share price? And does Hong Kong matter to Microsoft? Right? And does Amazon really care about Brexit? And if these companies are going to be as dominant as what we think they are, then maybe these look, you and I do geopolitics and talk like this for a living. We love it. We love this stuff.
Yeah.
But if we're honest, we've got to say, well, to certain companies, does it really matter?
Yeah.
Does it really matter? And if those 6 companies are the companies that drive the S&P, right? And the S&P being the ultimate barometer of global risk sentiment.
It is, yeah.
How does the S&P get affected by a Hong Kong democracy movement if the six best companies in the world don't care?
Yeah, or Brexit. Yeah, right.
Or any of those.
Yeah.
Yeah.
I love talking with you and sharing the.
This is great. We have to do this. We have to do this again very soon. We set out. What did we set ourselves? 20 minutes. We blew through that.
It's almost double, but no. I learn something from you every time I speak to you. I know you're a great macro thinker, and we're both, as our passion is both geopolitics and talking about.
You bring the best out of me. Thank you so much for this, and we'll do this again really soon.
Yeah, I hope so. All right, well, thank you so much. Be safe and stay well, and everybody the same as well.
Bye, everyone.
Bye.